morning and welcome to our webinar to discuss the 2026 mid-year outlook as well as the June FOMC meeting overnight. My name is Tai Hui. I'm the Chief Market Strategist for Asia Pacific at JP Morgan Asset Management. And for today's agenda it's quite jam-packed. First of all, I do want to go through the FOMC meeting last night. It's quite exciting in two ways. One, obviously, we do have a very different inflation environment, and you see that through the latest summary of economic projections. And of course, it's new Fed Chair, Kevin Warsh's first meeting, and there's quite a few takeaways, although policy rate remains unchanged, but I think there could be some important changes coming through between now and the end of the year, and of course, in the next couple of years as a new Fed Chair take over. And then for the second half of this presentation, we'll share some of the highlights from our 2026 mid-year outlook. In the spirit of the World Cup, hopefully some of you may have caught the football games in the last few days. We titled the outlook as "Don't Park the Bus." Don't be too defensive. I know there's been lots of questions and concerns with regards to the situation in the Middle East, which hopefully is improving. With questions about the AI developments, we've seen some fantastic returns. Question now becomes, have we hit the peak of these markets? And of course, with the Fed potentially looking to raise rates, investors can also be concerned. But I think the important takeaway is that there are plenty of solutions to a lot of these issues, and therefore parking the bus, being too defensive, is really not the way to handle these uncertainties. So let's start with the Fed. I do want to start with a couple of key takeaways from the meeting. As I mentioned, no change in terms of the policy rates at 350 to 375. Unanimous decision, no dissent this time around, which is interesting. But I think there's been a number of important changes, both in the statements, but also in the forecasts. So on the screen right now, you see the latest summary of economic projections from the Fed. But in a statement, first of all, it's a lot shorter. I think Kevin Warsh did mention in the past, he doesn't really want to over-communicate with the markets, and therefore the length of the statement has been significantly reduced. And at the same time, some of the comments within the statement have shifted from dovish to neutral. Some would argue maybe even a bit more hawkish. For example, growth was referenced to being solid, and that productivity growth and capital investment is strong. And that's consistent with Kevin Warsh's view that AI is delivering potential for productivity gains. And also the labor market is improving, and the rise in prices relating to energy supply shocks, although it did emphasize the central bank's commitment to deliver on price stability. So I think the assessment of the Fed, or at least the FOMC, is that the economy is in good shape. So I'll come back to this table in just a moment, but just want to show you the inflation numbers. As you see on this inflation charts on the screen right now, we did get a pickup in headline inflation. Not surprisingly, the pickup in gasoline and energy prices since the start of the US-Iran war contributed to this pickup in headline inflation. The good news is core inflation is still relatively steady. So from that perspective, the Fed, I think, does have a bit more room for flexibility when it comes to inflation. And then just again, to deep dive into some of the components, not surprisingly, on the right-hand side of this page right now, the purple bar, the motor fuel and other energy commodities have really been the major contributor to the pickup in inflation. Now, the good news is gasoline prices on average is coming down. In the US, from the peak of around $4.50 per gallon, now back down to around $4, if not below $4. If you look at Brent crude prices, now it's below $80. So what you have right now is that the inflation pressure, the good news is I don't think it's spilling over into wage growth or into inflation expectations at this point in time. And at the same time, we should start to see the month-on-month sequential inflation come down on the back of cooling in gasoline prices. So the Fed, while some officials are maybe expecting room for rate hikes later this year, the reality is the inflation peaking, or the potential for inflation to peak, to me, it does call for the Fed to have more ability to hold for the rest of this year, which is our core view at this point in time. And then for the labor market, I think why more Fed members feel comfortable with no cuts or even raising rates later on is because we do have improvement in the job market. If you look at non-farm payrolls on the left-hand side, we've had some very strong non-farm payroll changes in the past 3 months. It does indicate that the job market in the US continues to be in good shape, despite some of the job cuts we saw in the governments early in the year with Doge, rather last year with Doge, and also all the fears about AI taking over and replace some of the jobs in the markets. That's clearly not the case at this point in time. So with a decent job market, with some inflation pressure, it's not surprising that Fed members are adjusting their views. So let's look at the summary of economic projection. So if you look at the growth numbers, we did get a slight downward revision in 2026 from previously 2.4% to now 2.2%. Not really a big deal. But if you look at PCE inflation, the headline inflation, there's been a substantial upward revision in forecast from originally 2.7% in March to 3.6% in the latest round of numbers. Again, reflecting that pickup in energy prices and headline inflation. But if you look at 2027, 2028, the changes are frankly negligible. But I think where the most important thing or most important point the market picked up on, as well as if you look at the futures market, is really the change in the Fed funds rate. So in March, the consensus for media was for policy rates to drop to 3.4% by the end of the year, which effectively implies 1 rate cuts. But right now, you can see the median is 3.8%, which implies that FOMC members are looking not for rate cuts anymore, but rather for increase in interest rates potentially between now and the end of the year. In fact, 9 out of 18 FOMC members, that did not include Chair Warsh because he did not submit forecasts. Half of them is actually expecting maybe room for 1 interest rate increase. And that's why you now see the futures market is pricing in 1 full hike of 25 basis points in October, because more Fed members are now expecting, or at least forecasting, interest rates to increase. Now, do we agree with that? Not entirely. As I mentioned earlier, we do expect inflation to be approaching peak in May, June, over this month or next month or so, and therefore the overall trend is for inflation to ease back to below 4% before the end of the year. Sure, it's still above the Fed's target, but if we're not seeing that spilling over into core inflation or inflation expectations, I think the urgency for the Fed to raise rates is still not there. And at the same time, with the potential slowdown in CapEx coming through AI, I think that again, the Fed may want to be a bit more balanced when it comes to raising rates to cool inflation, but at the same time, not to choke growth. I think that to me is going to be really quite important. Now, beyond the forecast as well as the statements, Chair Warsh did mention a number of interesting points in terms of what he wants to achieve. Now, with new management coming in, quite often there will be new directions and also new objectives. And Chair Warsh did use the press conference as an opportunity to announce 5 task forces that will look at a number of topics. They will start looking at it maybe in autumn, with reporting back at the end of the year. And first of all, it includes the frequency and the type of Fed communications. Now, Fed Chair Warsh did mention that I think he does think that the Fed may be communicating a little bit too much with the markets. So the question is, could we see maybe fewer press conferences or even no press conference? Maybe there are even fewer or reduced length of statements. That remains to be seen. Number 2 is on the Fed's balance sheets. Again, Kevin Warsh did mention a number of times, including in his testimony to the Senate or the hearing of the Senate or confirmation that he thinks the balance sheet should not be used proactively, i.e., he sees room for a reduction in Fed's balance sheets. Now, again, how that could be done or the magnitude of the reduction remains to be seen. And then the use and reliance on source data, for example, how they look at inflation. Do they use PCE deflator, which is Fed's preferred measurements of inflation, or do they use what we call the trimmed mean inflation, which is so core inflation, simply put, is headline inflation, take away fuel and food, because these are seen to be more volatile components. And I would also argue that they are really out of Fed's control. Fuel and food typically is driven by global markets. No matter how much you raise rates or cut rates, people are not going to eat much less or much more, or they're going to use less fuel or more fuel. So from that perspective, the traditional argument to look at core inflation is because core inflation is a better reflection of demand, and this is what the Fed could arguably influence with policy rates. The trimmed means measurement effectively is not just taking out two of the more volatile components, but rather they look at every component and they take out the extremes. For those of you who follow things like gymnastics or diving, what you have is, in a scoring system, you often take out the highest score and the lowest score, regardless of which judge gave out those scores. And therefore, you get a more sort of immediate type of measurements. The trim means methodology is very similar in a sense. You take out some of the more volatile components. For example, in some months, you would see arguments where maybe struck prices or mobile phone charges on the insurance premium that's leading to a spike in inflation. So the idea is that we take out some of these one-off events, and therefore you have a much more smoother inflation, hopefully reflecting the underlying trend rather than just some one-off events or industrial changes that leads to volatilities in inflation. So I think the pros and cons to each argument, but again, I think those changes, frankly, does require better communication. So I'm personally not convinced that reduced communication is a good idea. Many of you who have been in the market for a bit longer, you may remember or have heard of the Greenspan's briefcase. What that was that because Greenspan was very poor, it's not very good at communicating with the markets or deliberately obscure in communicating with the markets, people use various metrics or guesswork to trying to extrapolate what the Fed's going to do. And one of these sort of urban myths or urban legends was that Greenspan's briefcase, if it's bigger or smaller, if it's thicker or thinner, it shows he may be looking for a change in policies, because a bigger briefcase indicates that there's a lot more materials in this briefcase to argue for policy change. If it's a smaller briefcase or a thinner briefcase, it means it may be just more of a BAU meeting. Now, he did joke in interviews that he did deliberately stuff his briefcase with a packed lunch to make it look bigger, just to mess with the press or mess with investors. Now, while this may be a joke, but at the same time, it does indicate that communication is important. Otherwise, markets will find different ways, even if they're not particularly scientific, to trying to guess what the Fed's going to do. So with all these potential changes on the Fed's balance sheets or ways to measure inflation coming through, I would personally argue that communication continues to be super important. Another task force is going to be on productivity and jobs. With AI coming in, I think, again, Kevin Warsh's view is that AI can be a huge booster to productivity. More of a question mark of what that influence on jobs. So again, more research in this area. And finally, as I mentioned earlier, the Fed's inflation frameworks. How do they measure inflation? Whether they should be more forward-looking or to take what we have right now on making policy decisions. So I think, the good news is many of these changes make sense, right? I mean, to take into account how AI impact on productivity, on the economy, I think that makes tons of sense. Always looking for ways to improve your analysis, to make use of better data, maybe even real-time data. to make policy decisions. I think that makes a lot of sense too. But I think all of which does require constant communication with the markets, and therefore the part where they are reassessing the frequency and how to communicate with the markets, I would personally advocate for a consistent way of communication and really keeping markets informed. Otherwise, markets will find obscure ways to try to second guess what the Fed's going to do. So overall, I think the meeting is interesting in two ways. One, we are looking at maybe a more hawkish Fed, at least for the time being, in line with what we saw with the European Central Bank last week with its rate hike, as well as the Bank of Japan earlier this week. But it does not necessarily mean that a rate hike is a done deal. Ultimately, inflation is likely to ease, or especially on a month-on-month basis in the coming months ahead. And what that means is the Fed could potentially have a bit more flexibility when it comes to policy decisions. Our view is on balance. We still think the Fed could well hold for the rest of this year and reassess in 2027. But of course, a lot of this is going to be basing on the energy prices as well as the macro big picture coming through from the US. And that brings us to the mid-year. Now, 2026 has gone really quickly. We're now already approaching the end of the first half. And we did get a lot of questions along the way in terms of what investors should be looking out for in the second half of the year. So, as I mentioned at the start, our mid-year outlook, the title is Don't Park the Bus. For those who are less familiar with football, that is a terminology that we use to say, look, we're putting all the players in front of the goal or towards the defensive end and trying to block opposition from scoring goals. Now, that is a very unpopular way to play football because spectators don't like it. Frankly, often it doesn't work either, because while you may put most of the players at the back in defense, the reality is it doesn't really make a lot of sense, because it just means that you get a lot of pressure from the opposing team that keep attacking and attacking, and once in a while you will lose a goal. So I think from an investment standpoint, as I mentioned earlier, all the uncertainties from the Middle East, which I'll come back to in just a moment, questions of AI, whether we are now at the peak of the cycle, as well as the uncertainties from monetary policy, all of these are creating anxieties and questions from clients. And quite often they will just shirk back to, well, I don't know where the world's going to be. I'm going to just park my money in cash. That type of ultra defensive strategy, I don't think is going to work. Because ultimately, A, you are going to lose out on potential opportunities. And B, there are going to be scenarios where cash will continue to underperform. So I think that's where we think, by addressing the questions on the screen right now, for example, the Middle East conflict, AI developments in both globally and in China, the midterm elections in the US in November, what does that mean? The new way of diversification via alternative assets, and also the question of growth versus value. I think these are all really important questions, how we can address the issue of asset allocation in the second half of the year. If you want to get our full report, we've got a QR code here, so just watch out for that. But just a couple of highlights I want to bring up. Now, first of all, when it comes to oil, look, the good news is US and Iran seems to be on track to sign a new ceasefire agreement, or this, a memorandum of understanding, an MOU. President Trump did mention this morning he's already signed it. You know, they're going to be in Switzerland tomorrow to sort of formal signature. But the most important thing from our perspective is whether the Strait of Hormuz will be reopened quickly. Now, we did put out a note on Monday highlighting our views. A couple of things to watch out for. Number one, we don't think the Strait of Hormuz will be open right away, not because US and Iran don't want to, but because of the logistics. First of all, there are questions on whether insurance companies will offer insurance, will underwrite insurance, and whether shipping companies will feel comfortable to let their ships through the strait once again. So the logistics and the insurance question mark needs to be addressed. Secondly, it will require time for ships to be unloaded and reloaded, and really just to get through back towards through the straits to their destinations. The number of ships, hundreds of ships that got stuck in the Gulf, and one sounds trivial but not trivial point, and that its barnacles are actually forming at the bottom of the hull. That makes traveling less efficient, more fuel consumption. So again, there are all these so-called minor issues that practically it does create a bit of a lead time, a bit of a time lag in normalizing shipping fully. And of course, with the disruption that we saw in the Gulf states over the past few months, reopening oil rig, gas production facilities, refined facilities, logistic facilities. These are not just turning the tap on and off as easy as that. It does require some testing to make sure that everything is safe. And therefore, again, this is going to require several weeks, if not a couple of months, to get back to full flow. And this does not account for facilities that were damaged during the conflict when the Iranian forces were using drones in order to attack those facilities. Those will take even longer to get back online. So I think the market obviously will be running ahead of itself in terms of pricing in a reopening of the strait. We saw that already with Brent crude below $80. There's a very key indication. But at the same time, logistically, from an economic standpoint, we will require some patience for that normality to resume. But nonetheless, I think it is good news for risk assets. We did see a strong reaction on Monday and Tuesday from the markets with the news. I suspect once you start to see shipping traffic slowly revert back to normal, the market will continue to price that in. So I think the first opportunity here is, before we start talking about AI, we could be looking at some rotation away from technology into more cyclically sensitive sectors. This could be financials, this could be industrial, this could be sectors that were or are exposed heavily to energy. For example, transportation, whether airlines or shipping companies will see better days because of lower energy prices, because of resumption of supply. All of these could offer opportunities for investors who may want to diversify, not reduce or eliminate, but diversify their allocation from technology to a broader suite of sectors and also geography. You saw, for example, ASEAN markets, especially Indonesia, react quite positively on the back of this news. Again, many emerging markets have been hurt quite badly with the supply disruptions, and the resumption of flows could potentially help these economies to get back on a more stable footing. All of these are opportunities that investors should be looking out for. So that's the first thing. But at the same time, in the mid-year outlook, we did discuss the less positive scenarios. If we do get a resumption of conflict, what does that mean from a stagflation perspective? But the good news is, I think we are right in calling for a more optimistic, more benign outlook for the second half of the year. But if you're interested in the more extreme scenarios, it is available in the mid-year outlook. Now, the other question, of course, is on AI. I think what we have right now is really strong adoption by the corporate sector. That's great news. However, I think there are questions being raised on a number of fronts. First of all, from adoption to monetization, are AI hyperscalers able to generate revenue with their model? So all the investment that goes into data centers and developing their models, are they able to charge people accordingly? I think that remains a very significant question mark. The other risk that we see right now is obviously from a policy standpoint, whether it's because of national security concern or because of potential public pushbacks on data center constructions. Does it mean that, when a hyperscalers or model developer develop an excellent model, very powerful model, could their market size being constrained? For example, if the US government tell a particular company, you can only make this model available to Americans and not to other users, even though they may be allies in Europe or in Japan or in South Korea, does that limit the scope of these models and therefore the ability to monetize? That remains a question mark. And of course, as we saw in some parts of the US, there's been significant public discontent over construction of data centers. So what does that mean for the availability of compute power? All of these, I think, are questions rightfully asked by investors on some of the outlook for AI. To me, over the long term, we still see AI to be a very positive development. I think the monetization question will be resolved in time, but I think the patience of investors will be tested in the second half of the year. And therefore, you saw a rotation away from so-called Max 7 in the first half of this year towards the hardware, semiconductor memory chips, which you see more instant gratification when it comes to earnings growth. So if you look at South Korea, for example, if I fast forward to this page, Korea price to earnings is still at below 8 times, despite Kospi, despite MSCI Korea up more than 100%. Why? Because Korean memory chip companies are generating significant earnings growth that is able to match the return on their stock prices. And if you look at their ability to generate earnings, I think the earnings support remains there because ultimately the shortage of memory chips is still there. And it's not something that you can easily expand on production in 3 to 6 months or even 6 to 12 months. For example, one particular company, a leading player in memory chips, they did mention they want to double their production capacity, but over the next 5 years, not over the next year or two, but 5 years. It takes a very long time to produce or to expand capacity. So in that sense, the shortage of memory chips is not going away anytime soon. The pricing power will remain intact. However, it does mean their ability to grow their volume of production is also limited. So for example, if you look at MSCI Korea, 2026 earnings growth is over 100%. 2027, currently analyst consensus is about 20 to 25%. It's still a really strong number, but obviously we're not going to get that triple digit or even 50, 100% growth sustained over the long term. So I think from that perspective, we feel reasonably comfortable about the outlook for Northeast Asian markets. But I think to repeat the performance of the first half or the last 12 to 18 months for Taiwan and South Korea to us is going to be really quite challenging, not because we see an imminent correction in the markets, but the capacity constraints that leads to that very strong bargaining power for semiconductor manufacturers could also be a bind on how fast the earnings growth could be going forward into 2027. So from our perspective, we have to be realistic on the equity market returns in the US and also in Asia in the second half of 2026. We still remain constructive overall, but I think most people would agree with me that the type of return that we've seen first half this year in markets like Taiwan, South Korea, and Japan are very difficult to repeat in the second half of 2026. And therefore, the importance of diversification, looking for rotation opportunity, that to me continues to be absolutely critical. For example, as I mentioned earlier, in the US, could we be looking at more cyclically sensitive sectors that have been beaten down in the first half of the year because of high energy costs? Or in the case of, for example, China, if you look at the index level, it's not been great. It's been somewhat disappointing. But if you look at some of the AI-related companies, both in the Asia markets and also in the Hong Kong market, that have been listed in the last 6 to 12 months, those who are in semiconductors production in China or model developments, those companies have actually done quite well alongside with the US companies. So, I think the problem with China is that a lot of the heavyweights are either state-owned companies like banks or traditional companies. For those who are heavyweights in the tech sector, the e-commerce giants, the internet giants, they are slowly they're integrating AI into their models, but how they monetize it remains to be seen. And therefore, you don't see as much of a movement in the index level. I feel optimistic about these guys in the longer run, but for those who are looking to tap into the China AI story, I think you really have to go company by company. Active management is absolutely essential. There's no argument against it in the case of the Chinese market. So in that sense, I think there's still plenty of opportunities in equities, but you really need to look at a much broader range of opportunities, not just narrowly focusing on technology. I suspect you will see a bit more of an even performance between tech and non-tech in the second half of the year. Now, for fixed income, I think the key here, as we saw overnight, is that the more hawkish position from the Fed has led to a flattening of the yield curve, with short end 2-year up about 13 basis points, with a longer end up only about 4 basis points. And that trend continue in the short term. But from our perspective, we believe that fixed income continues to be a very critical part of asset allocation. Again, I can fully appreciate that the return profile of equities versus fixed income, people may want to concentrate in equities or may have concentrated in equities in the first half of the year. But the reality is, if, as I mentioned earlier, return profile of equities will look still good, but less impressive compared to the first half, the relative appeal of fixed income should continue to improve. And that, again, in areas such as corporate credits, if we are moving away from a recession scenario to a decent growth scenario, that typically benefits corporate credits, or at least able to maintain the corporate credit spreads. For government bonds, of course, there could be opportunities, tactical opportunities. For example, if, for example, the Reserve Bank of Australia, they're nearly done with raising rates and they could be looking to cut rates next year, does that mean there's opportunity in Australian government bonds? Or in the case of the ECB and the Bank of England, of course, they may be in a rate hike cycle, but if the rate hike cycle is going to be short, and with an easing of inflation later in the year, could they have more room for flexibility to cut rates in 2027? All of these to us, I think it does offer tactical opportunities when it comes to government bonds. But overall, we would still prefer the shorter end of the yield curve. We're happy to sacrifice some carry in terms of the steepness of the yield curve. However, the fiscal concerns as well as bond market volatility, to us, we still prefer the shorter end. Coming back to my earlier point about communication, the Fed Chair Kevin Warsh wants to be a bit more succinct in his communication, or less communicative with the markets. I think the byproduct is you may see more volatilities, and that again argues for maybe a shorter and a short duration view on government bonds. Now, final 2 points. One is on the dollar. Now, we did see the dollar break above 100 in the dollar index once again overnight, with a more hawkish Fed and the pickup in short end of the yield curve. That said, I think with the agreement between US and Iran hopefully be sustained over the coming weeks, risk appetite improving, that to me continue to point towards a weaker US dollar. That to me is still very important. For gold, I think gold has been a surprise to everyone. During the war, we've seen gold did not act as a hedge. If anything, it's been used as an ATM for investors to draw liquidity to maintain their liquidity position. So I think if we do get peace, or at least some sort of ceasefire sustained, you might actually start to see gold improving again. Now, of course, gold also got beaten down recently because of the rising rates or prospects of higher rates. But I think 2 things. One is that central banks continue want to add gold to their portfolio. I think that trend will continue. And secondly, with risk appetite returning, investors may want to go back to gold. So I think these 2 factors in play, we're still, I would say, medium-term supportive of gold as part of the portfolio. And we can speak a lot more of that in our upcoming Guide to the Markets call in early July. But overall, I think gold still plays a very key role in overall asset allocation. Final point, alternatives. Clearly, what we see right now is income generation from alternative assets, whether it's infrastructure or transportation or even private credits, continues to be key. And I know there's been a lot of anxiety amongst private credit investors, but to me, the challenges facing private credit right now, it's more from retail investors withdrawing rather than a fundamental deterioration in credit conditions or credit quality. Sure, some software companies may find it difficult in the medium term because of challenges with AI, but there are plenty of other companies in non-tech sectors that we feel comfortable investing in. And that, again, requires a very thorough research and understanding of credit profile of companies when we look at private credit. So again, we do encourage investors to broaden out their investment horizon, not just from public markets, but also private markets. And even within private markets, we do think that there are opportunities in income generating assets. Transportation and infrastructure has always been the bedrock of how I would think about alternatives. But I think private credits, the fact that we've seen some anxiety in the last few months, to me, the fundamentals are still in reasonably good shape. And I think that is really down to the fact that I think many of the retail investors, they don't fully appreciate the less liquid nature of private credits. And that, to me, has led to some volatilities in that particular market. So in summary, two parts. The Fed, we think the Fed has room to hold between now and the end of the year. We don't fully agree with the idea that they have to raise rates later, maybe in springtime, or sorry, in autumn times. But the number of changes that could be introduced by the new Fed chair definitely requires some more attention. I think my colleagues in the US will be spending a lot of time researching on those topics and will report back in due course in the months ahead. For the second half of the year, I know there's a lot of uncertainties, questions about the geopolitics in the Middle East, questions about what's happening with AI development and a potential pullback from there. And of course, as a result of a more hawkish Fed, could we see more volatilities in the markets? I think a key takeaway, the key message is don't park the bus, don't be too defensive. We think that the improvement in the geopolitical situation in the Middle East does offer an opportunity to rotate into non-tech, more cyclical sectors. And also, we have to be realistic that the return profile of technology in the last 6 months, maybe in the last couple of years, we could see a quieter period. It does not mean imminent correction, but I think a broader allocation into things like financials, industrials, transportation, these sectors, to me, opportunities are plentiful, not just sectorially, but also geographically. We still like Asia a lot. Korea and Taiwan, we think they continue to be leaders in semiconductors and memory chips. They have very strong pricing power, although the ability to expand capacity in the short term is still limited. In China, active management continues to be absolutely critical. And also maybe opportunistic opportunities or tactical opportunities in Southeast Asia after a very challenging Q2. And at the same time, if I think longer term, after the US-Iran war again, hopefully reach a point of stability, investors will be asking questions, what lessons have we learned from this episode? I think number one, energy dependence and security has to be on top of minds of policymakers and corporates going forward. Where do we get oil and gas? Can we still focus as much on the Middle East as before, or do we need to diversify? I think that's a key question. Should we buy more from the US, or should we import more from the US? Number two, should we diversify our energy sources into non-fossil fuels options? Renewable energy, that is a key discussion topic. After the Russia-Ukraine war started, Europeans are thinking very hard about solar, wind, hydroelectric, even thinking about nuclear power being reintroduced to their economies. That, again, is going to be critical. And of course, that does mean a potential reconfiguration of the grid, as well as energy storage options, and of course, electric vehicles. Second question is on defense. We've spoken a lot about governments in Europe, in Asia, rethinking their defense strategy, the defense spending. Obviously, many want to spend more. But one thing that came out of the US-Iran conflict is Iran, frankly, managed to hold this position with high volume, low unit cost weaponry, such as drones. And therefore, I think the defense investment going forward is not going to be only about the best and the biggest missiles or fighter jets or warships, but also about more agile, autonomous devices that can swamp their enemies in volumes. So again, that could imply a very different industrial architecture when it comes to defense spending. So I think all these offers a lot of food for thought. And again, we will inform you and sort of share with you our thoughts in due course. But to me, it does open up a lot of different opportunities and ways to hedge your portfolio, to construct a portfolio in a resilient way. So I think the key here is being ultra defensive is not the way forward. We have a lot of great players, a lot of great assets that can help to build a portfolio. Our next web conference is going to be in the second week of July for our Guide to the Markets APAC web conference for the third quarter of 2026. And of course, as always, you can reach out to your JPM Asset Management client advisors for questions. We also, of course, have the podcasts as well as our On the Mars of Investors that hopefully address all the burning questions from our clients across the APAC region. So thank you very much and have a great week ahead. Thank you.